Welcome to Breaking News to Trading Moves. Today we're looking at a report from the energy storage sector that seemed to draw a pretty clear line in the sand. It created a distinct set of winners and losers across a few industries.
That's right. We're talking about Fluence Energy, ticker FLNC.
And this is exactly the kind of event that helps you, the learner, see where capital starts to flow next.
We'll look at why their update was so influential, and then we'll get into the details of which companies got a boost and, well, which ones face some new pressure.
Okay, so let's start with the main event, Fluence Energy. They put out their 2025 financial results.
They did. And at first glance, you might have, thought it was a mixed bag. The revenue figure was actually a bit softer compared to the year before.
So what was it that got investors' attention? It obviously wasn't that top-line number.
No, it was all about the bottom line and the outlook. Yeah. The critical piece was a really solid improvement in their margins.
Margins, okay.
Yeah, and that came from better operations and more stable supply chain, that kind of thing. It allowed them to post a profitable fourth quarter.
And that's a big proof point, isn't it? Showing they can actually make money on these large projects.
It is. It's a validation point.
Yeah.
But where the real excitement came from was the 2026 outlook.
Right. What did they project there?
They guided for strong revenue growth and better EBITDA for 2026. But the single most important number they announced was their record backlog.
Let's pause on that, because a backlog for a company like this isn't just a list of possibilities, right?
Not at all. It represents firm, legally binding contracts. These are deals that are already signed.
So why did that move the market so much?
Because they stated that this backlog, just what they have on the books right now, already covers most of their 2026 revenue target.
Wow.
So it's not a forecast based on hope, it's revenue visibility. For an investor, that takes a lot of the risk out of the equation. It confirms that demand is locked in.
That makes perfect sense. Locked-in revenue versus a projection. Okay, so let's track the money. With Fluence showing this kind of strength, where did the immediate benefits show up? Who were the direct winners?
Well, the first place you saw it was across the entire utility-scale storage space.
So other companies doing the same thing.
Exactly. Fluence's success confirmed that the business model is maturing. The higher margins, the strong backlog, it all pointed to broad sector health.
So investors weren't just buying Fluence.
No, they were encouraged to rotate into other names with that same direct exposure. We saw positive moves in companies like Eos Energy, that's EOSE, and also STEM, STEM.
So Fluence's good news acted as a kind of proxy for the industry's demand.
It did. It gave a credible look at the entire industry's underlying demand and, potential for profit.
Okay, so that leads us to the second winner category. If the storage providers are doing well, I assume their customers are also in a good position.
Precisely. The next group of winners are the utilities, the ones that are heavily integrating large-scale storage into their grid operations.
And who are we talking about here? And why do they benefit from Fluence's better economics?
You're looking at names like NextEra Energy, NEE, and also AES Corp, AES.
Okay.
And the reason is pretty straightforward. Better storage performance means they can deliver more reliable renewable power. But it also helps them reduce something called curtailment.
Let's define curtailment for a moment. That's essentially wasted energy, correct?
It is, and it's a direct financial loss. It's when a solar or wind farm is producing power, but the grid can't take it, so they have to just shut it down.
And storage solves that.
It's the solution.
Yeah.
You can capture that otherwise wasted energy and sell it later. This makes their hybrid storage projects, solar plus battery, much lower risk. It really boosts the profitability of each renewable project.
That makes a lot of sense. And this brings us to the broader grid infrastructure. If you're building out all this battery storage, you need more than just the batteries.
Absolutely. The momentum spills over.
Yeah.
As utility storage grows, spending has to increase on all the supporting hardware and related industrial systems.
Okay, so this would be companies that focus on things like industrial batteries and energy backup systems.
That's right. This gave a lift to companies like Generac, GNRC, and also ENERSYS, ENS. The market sees a growing storage sector as, well, a rising tide for those who provide the essential equipment to manage all that stored power.
Okay, so we've got a clear picture of the winners. Now let's turn to the other side of the coin. If energy storage is improving, who stands to lose out?
The most direct losers would be the fossil fuel power generators, specifically the ones that run on natural gas, the peaker plants.
Peaker plants. Their whole job is to turn on during times of high demand when prices are highest. How does storage undermine them?
Well, storage does that same job, but better and increasingly cheaper. Peaker plants are only profitable because they can charge very high prices for electricity for just a few hours a year.
And storage smooths out those price spikes.
It does. It can absorb cheap renewable power during the day and then discharge it almost instantly during those high-demand hours. So more storage on the grid means less need for these expensive gas plants.
And that directly hits their revenue.
It does. It reduces the number of hours they can run and the prices they can charge.
Which companies felt that pressure?
You saw some negative reaction in names like NRG Energy, that's NRG and Vistra VST. The market is basically concluding that better storage speeds up the timeline for these peaker plants to become obsolete.
Okay, now for the next category of losers. This one might feel a little less obvious. Residential solar installers. How does utility-scale storage affect rooftop solar?
It's mostly a story about capital rotation. When investors see a clear, de-risk growth story, like the one Fluence presented, money tends to move away from other segments.
And residential solar has its own set of risks.
It does. It's very sensitive to external factors, particularly interest rates.
Right, because most homeowners finance these systems over many years.
Exactly. So higher rates make rooftop solar more expensive for the customer.
Sure.
Companies like Sunrun, RUN, and SunPower, SPWR, they're dealing with that. So when Fluence's update came out, it gave investors a more robust, clearer growth story in the utility sector.
And capital followed the clearer path.
Capital followed the path with better visibility.
That brings us to our final category, diversified industrials. These are big companies that could be players in storage, but are, for now, seen as lagging.
Right. Fluence really set a high bar, not just on growth, but on margin improvement. And the market is now rewarding that kind of focused execution.
So it's not that these bigger companies are failing, just that they're moving slower compared to the pure plays.
That's a good way to put it. We saw companies like General Electric, GE, Honeywell, HON, and Emerson Electric, EMR, underperform a bit.
Why is that?
Well, for them, energy storage is just one of many divisions.
Yeah.
It might not have the same dedicated focus as a company like Fluence, where it's all they do. So in the short term, their slower progress makes them less attractive compared to the clear sector leaders.
So to wrap this all up, we started with a single event Fluence Energy's strong outlook.
An outlook that was backed by a record backlog and improving profitability.
And from there, we saw capital move in very logical ways. It benefited other pure-play storage companies, the utilities that use the tech, and the broader grid infrastructure players.
And at the same time, it put pressure on the business models that are most threatened by it, like gas peaker plants. It also pulled investment away from more complex areas like residential solar.
The key takeaway for you, the learner, is just how quickly one company's operational success can redirect investment across the energy landscape.
Right. Seeing how contracts and margins can shift perceptions of risk helps you understand which business models in this transition are built to last.
We appreciate you trusting us with this information. Please remember that the information discussed is based purely on the opinion of the author of the provided material and the subsequent market reaction to the headline event. This is not financial advice, nor is it a recommendation to buy or sell any security. Always conduct your own research.